Welcome, guys. This is First Lady Harmonic here. Um, just going to put together some videos for you guys. A lot of people have been asking for me to put together some videos. So been thinking about it for a while and going to do it for you guys here. Just give me some room. It may take me a while because I am so busy. But anyway, so First Lady Harmonic here. Most people know that I trade harmonics. That is about 99% of how I trade, how I do the market. And what I wanted to share with you guys is, what steps you may need, what things you may need to know in trading the market. And so let me just clear some of this stuff. I hate my charts looking so, ugh. There we go, like nice clean charts. There's a few things that it's a couple steps that you may need to know when mastering the market. That's going to help you to become a successful trader. I'm going to write them down for you, and something that you can write down yourself. The first thing you need to understand is raw market movement. The second thing would be supply, to say support and resistance. And this is these what I'm talking about right now. These are the very basics in trading. A lot of times we learn the basics, and then what happens is we start applying different methods and to trade, and if you get the basics. But if you understand the basics and you stick to the basics and you add those on to the method in which you're trading, you'll see that you have no choice but to do well in the market. So again, there are about 7 steps. The first one is raw market movement. The second step is support and resistance. The third step, what I like to do is I call trap the price. And sometimes you'll see that I don't always do that, but this is just a method in helping you to understand in which direction price would be currently going. And I mean in reference to per candlestick, and not so much as reference to the trend. You want to track the price, or you want to track the price via channels. There's also something that I do is called a candlestick formation or candlestick analysis, candle by candle, and this helps me decide whether or not I will be entering the trade, exiting the trade, or either beginning to or entering, exiting the trade, or staying in the trade. Sorry about that. So it's a candle by candle analysis that I will be applying. And then you have the options of using Fibonacci. And because I trade by means of harmonics, Fibonacci is not a necessary, it's an option. It is a necessity. Depending on the method in which you trade, Fibonacci is an option. But my course that I will be sharing with you guys and how I trade, I'm not even going to say my course. I'm going to share with you how I trade, what I see in the market, how I see the market. Fibonacci is the main tool in which we'll be using. Again, we have harmonics itself. And then, of course, always would be risk management. So these steps right here is what's going to, let's get it at 20. Understanding this right here, this is going to give you success in the market. You're going to be able to master the market with this. Raw market movement, i.e. market structure. Also in reference to harmonics and the manner in which you see the market, how it actually moves. Support and resistance, again, market structure, supply and demand zones, where price is going to go, where they're picking up, where the banks and so forth are picking up the liquidity in the market before they make the next move. You can track the price. You can track the price via channels, understanding that price moves in, or let's say by means of a train, but the train is always on a track, and the station in which is going from one station to the next station. So you want to look at it from one standpoint. You want to enter at the train station, a good train station. You never want to enter or get on a train in the middle of the track. You want to get on a train at the train station. So therefore, you want to be at a nice level of support or resistance and understand that this train is moving on a track to the next level of support and resistance. That is how price works. It moves from one level of support to resistance, and either breaks resistance and retests it as support, and it's moving to the next level of resistance. A candle by candle analysis is going to enable you to understand whether or not you should be entering, exiting, or staying in the trade. Of course, Fibonacci is something that is a vital tool in harmonics, because understanding that the market moves in impulses or moves in waves, or there's a movement and a structure to the price action, and it's called advanced harmonics. And then, of course, there's risk management, understanding that you never want to risk more than you're willing to lose. People always ask, oh, 5% here, 10%. I'm not one for that. You know, people's personalities and who they are and how they trade is very different. Some people are conservative, some people are aggressive, some people just don't even know what they are. So my advice when it comes to that is never risk more than you're willing to lose. And then once you are in the trade, I call it EME, enter, manage, exit. So once you enter your trade, you want to manage your trade, and then you want to exit the trade. And that's where the 90% of your psychology in trading comes from. You know, technically they say trading is 10% technical, 90% mental, which I do agree, because you have to have a certain level of discipline and mental stability when you are trading. And it only happens, your mental stability and your discipline only happens once you've entered the market. You can sit and analyze trades, the market and the charts all day long, but it's not until you enter into the market that you'll find that you have to use some type of mental stability. So on that note, those are the things that is very important and help you to master the market. So I hope you wrote this down. If not, you can catch it, just rewind. But anyway, so let's go and let's look into raw market movement. So what is that? Well, it's simply how you see the market. It doesn't look like there's much data here. Let's go to the daily chart. Maybe some more. Okay, there we go. It's simply how you see the market. And just look at the screen right now. I mean, what is it that you see? A lot of times we look at the market, we look at these charts and we say, well, I see a whole bunch of candles, I see a bunch of wicks and stop hunts and things of that nature. But what I see is just simple movement. And I am going to, I don't even know where that box is. There it is. I'm going to show you what it is that I see. I see the market moving in waves. So I'm going to pinpoint what those waves are to me. I see this low that happens right here. And then I see a strong push up. I see a push down. I see it push up again. I see it push down. Then I see it push up again. And I see it push down. And I see it push up. And I see it push down. It's going to sound quite redundant. Now these are impulse legs or impulse moves, better known as points of reactions. These movements, these large movements, are movements that the institutions, the banks, the hedge funds, these are the moves that the big boys make. Small moves, these are not retail trader moves. These are not moves that you and I can make, even with all of us together. We don't have that kind of money. So you see moves like this, the idea is to either predict the move and get in the move with them, or you can follow behind them. Of course, following behind them is more conservative, more aggressive is making the move with them. And sometimes even before them. Usually when you do it before them, you're sitting in either some type of consolidation or a little bit of drawdown. But anyway, before I start ranting on about that, again, this is a move, this is a move. And you notice that there's smaller moves in here, as you can see. These are the smaller moves within the larger move. And these are impulse moves as well. And how do you know what an impulse move is, what an impulse leg is? Usually it breaks a high or a low. So you have this move here that has broken this low. It's just created a hit, has come back up and retested, which is part of market structure. Before I get into that, though, I wanted to show you, but I'm not going to continue making the smaller moves that you can see. These are smaller moves here. I'm just going to make the large moves at this point. Right here, we come down, we come up, we come down. And so this is how I see the market. I see the market not in candlesticks. I'm not even worried about candlesticks at this moment. I just see the moves that it makes. And then from the moves, this is where your Fibonacci comes in, because they're all measured moves. So to you, it may look like right now a whole bunch of zigzags, and that's what they are, zigzags, but they're all measured moves, and that's what harmonics, that's what they are, measured moves. So again, like when I first got involved with the market, understanding that the market's really nothing but M's and W's. M's and W's, yes. The double tops and double bottoms. The market only moves up, down, and sideways. And then making, how can I say, pictures, so to speak. And when I say M's and W's, I'm going to show you. A W usually is a double bottom. You see double bottom? You see double bottom. You see that? Or you can say double top, double top. You see the double top here? This is, you see the M? Can you see the M? Can you see the W? Right? Here goes another double bottom. So what happens is you want to identify those areas. And when you start seeing things like a double bottom, you can start measuring and saying, okay, well, we're probably going to end up where? The harmonics is just a way it gives you a directional bias, and also gives you a good idea, very good idea, of where you're going to enter and where you're going to exit the trade. Okay? You have a double bottom, let's say, right here. You see, you have a W. But then you also have a W right here. So again, it's what I want people to appreciate is an M, it's a double top as well. It was a double bottom. So what I'm trying to help people to appreciate is really the manner in which you see the market, how you see the market. When you see an M, when you see a double top or a double bottom or M or double, whatever you want to call it, you know, that's giving you a clue as to what's going on in the market. And it's giving you a clue of how you can start to measure the market. Again, double bottom. Now, without any of this, what happens is when you begin to see the market this way, you don't even need to do this. Your eye can just pick up on it. And I didn't believe it when I first learned it. They said you'll be able, once you see it, you won't be able to unsee it. And that is absolutely true. You will not be able to unsee it. So there's also an indicator. It's called the zigzag. You can put that on your chart as well, and it will do this for you, and it will help you to identify the impulse legs, and it will help you to identify possible harmonics within those impulse legs. So let's just take this particular double bottom right here. So we clearly already know that, take this off, this is a double bottom, right? You can see that. So impulse leg coming down, it has retraced here. The B point here gives you an indication as to what the harmonic will be. Now I'm just going to give you just one harmonic here, because right now this video is going to be more about, it's more about raw market movement, understand how the market moves. But I wanted to show you this particular pattern so you understand that as you see things like this, you have a move up, a move down, and then the market has retraced here to a 618. Now 618 on a harmonic pattern gives you a potential Gartley pattern, and the D point of a Gartley is a 786. And I'm not making this stuff up. As you see, here goes my X, my A, my B, my C, and my D. Let's just move this right here. Now, where do we see the price tapped out at? It rejected off with my 786. That is my Gartley pattern. So what I can do from this particular standpoint is now I have a good place, 100% chance of knowing that I can enter a sell on this trade. And why I say sell is because once a D point is hit, and this is what they call a bearish Gartley. Once a D point is hit, it usually retraces. The first take profit is a 382 or a 61.8. And the way you'll find that is you'll take your Fibonacci again from A to D, and you'll see here's my 382, here's my 61.8, and you see the price really just continue to drop. But still, these are your two take profit areas. Initially, you can do whatever you want to do. You stay in the trade and so forth and so on, or you can take your profit at 382, take half off at 382, whatever. There's multiple things that can be done. Again, don't want to get too advanced on that because that's a whole different video. So understanding market structure. So once you are able to really look at the market in that standpoint of impulse moves or legs or waves, understand that where price comes to a certain point and stops, that's a level of structure usually. And also the impulse legs, let's say from here to here is a high. This is also where you can place some structure. Let's just use this for now. That's a nice high. Let me take off this. So this is your level of resistance. I always use the wicks. That's where price has gone. Even though price is not closed down there, some people use the body of the candle. I use the wick of the candle. And the reason why is because market is driven by people. So a wick is indicating what? That there has been failure. So price has actually, this candle right here at one time was completely bullish. But the sellers were like, no, I don't think we want the price to go that high. And they drove the price down. So as humans, what do we normally do? Normally, the average person, when they fail at something, they usually like to retry again. So somewhere in this market, price is going to be at this point again. They realize we failed at this level, we're going back there again. So again, this is why I use the tip of the wick. I can actually use here if I want to, the tip of the wick. And if you want to do a zone, I do from the body up into the tip of the wick. And then a nice little trick. People don't realize they actually try to draw the zone out themselves. If you really just go to the coordinates, and these are the bars, it's at negative 396, you just change that to 1. And then stick with the negative. You put a 1 in front of it, and it takes it to 1,396 bars. And it drags it out nice and evenly for you. Of course, 1,396 bars. Who knows how far that is, but it's far enough that you don't have to be trying to draw it out yourself. So this is your high. We have here where price has come down. And what has it done? It has retested. So this market, basically what I'm telling you is that when price breaks an area of structure, it usually comes back to retest it. It doesn't always retest it immediately, as you can see in this area here. It has come down. It has broken this area. You see what I use? I use the body and the candle, the tip of the candle, of course. And you see how price came down, touch it again, came down, touch it again. And now it has broken this area of support. And once it has broken this area of support, because this next candle here closed below it, that technically is considered to be a retest. There's different kinds of retest. But the real retest of this newfound resistance is right here. Right when price came back up, resistance, it came, failed to break it, try it again, failed to break it, try it again, failed to break it, try it again, here's a stop point, failed to break it. And this is when you actually could have taken the sell. You could have taken it really right after this candle here. I would have waited for this candle, particular candle here. But down here would be a nice wick also. But that's a whole different video. That's on chart patterns and price action, things of that nature. Again, back to market structure. So we came back and we retested this area here. You see again, this was actually broken. This level of resistance was broken here, support rather. So this was the impulse leg. And so let's just look at it again. I'm trying to keep it real simple. You know, a lot of people, they do a lot of saying different things, but I really just try to keep it as simple as possible. And again, you see what happens. Price broke it. It came back up. It came back up to retest this. Once it broke it, it did a nice retest here, and then it went all the way down. So it's just simply what market structure is. And from this level here, you see what price does. It breaks it, comes back down, tests it, comes up, comes back down, and you see what it does. It tests it again. It tested it over here. So some people like to wait. They don't get into the trade at all. I'm not one of them. I'm a little bit more aggressive, but some people wait until this area is actually tested by the candles, specifically tested, and then it's confirmed that this is now no longer support, but it is resistance, and then they enter the trade. And we see that price has done that over here again as well. So this is what market structure is, realizing that in order to understand, you have to look left to get right. So seeing what price has done in the past here is going to help you to understand what's going on in the future. I mean, it's really just that simple. So you're looking for areas that, just clean this out. I use my impulse moves, so I would use this as an area. And so it'll come all the way down here. It has come all the way back up here. So I use the highest points as levels that will be tested. Now, you don't want to use a whole bunch of lines across the charts and things of that nature. This is just actually one way of understanding market structure and what price is going to do. I personally use the quarters theory because once you mark up your quarters theory, you never have to really worry about that at all. That's a whole different video. We're not going to get into that right now, but just understanding what price is actually doing. And understand that price is usually going to come back to a certain level to test it. And that's what you actually see going on here. You see price stopped right here. It tested it as it was support, and now it's resistance. And you know it's actually a good level of support or resistance if this level is tested as both support and resistance. Sometimes you don't get that. Sometimes you get it just tested as support. But if you see it being tested multiple times, that's a very good indication that your level of support or resistance is good and is confirmed. So right here, we have two levels. You have support right there. You have support right here. We have support right here. You see a nice rejection. It comes down, break it, and it's resistance here. You see that? Comes back down, and now it's resistance here. So this is a confirmed level, very strong level of support and resistance. Now it's actually resistance. And you can draw it out as a line. You can put a zone around it if you want to. But it's a very valid level of resistance at this time. And so, again, that's all it is. It's very simple, very easy. It's nothing complicated about it. Right here. Like I said, you don't have to put a whole bunch of lines, but it's more about understanding how the market moves. It comes back to test resistance. It comes back to test support. You see up in this area here, this has not been tested at all. So what's more likely going to happen? We're creating higher lows, so maybe it's going to come back down here to retest this level as newfound support, and then you're going to come up to retest these levels up here. But that's a whole different video, of course. So again, understanding what you're looking at. how are you seeing the market? This is currently where price is right now. Let's see if I can take off. This is my EMA of that nature. Again, so what are you seeing? Are you seeing moves? So learn to see the moves. Forget about the candles right now. Candles mean nothing. Candles only mean something, at least to me, when I'm about to enter the market and when I'm leaving the market. Other than that, I can care less about what the candles are. I'm just interested in the movements. And then once I see the big movements, I just measure. That's a different video. So do you see the movements? Can you see the bottoms? Can you see the M's? Can you see the W's? The market is nothing but M's and W's. Some sideways. There's some chart patterns, things of that nature, head and shoulders, inverted head and shoulders, triangles, flags. There are all that. Sure. Not saying that it's not. But overall, you want to learn harmonics, it's M's and W's. And then sometimes the W's inside the M. This right here, this one move right here, that's actually one move. It's one impulse leg with minor in front of it, but it's also a double top, but it also has a double bottom in it as well. So again, right now, this is just really about how you see the market. Learn to see the market in its moves, in its waves. Once you begin to do that, I'm going to say like 60, 65, maybe 70% of your work is done, because you're understanding now. Because once you understand this and you understand market structure, and once you see the impulse legs, you see where you can place your support and resistance. You know exactly where to place them. And you can put them really on the big moves itself. You don't have to put them everywhere, but you put them on the big moves. You see how this move right here, this is a daily chart. So this whole move right here, because it broke this previous high, very valid impulse move, right? So it's okay to put it here, but you see what price did? It came right back down here and retested right over here. So that's what you're looking for. You're looking for areas of, and this is what they call structure. This is what's called structure. So I hope that this video wasn't too long. I hope I didn't say too much or too little. If you have any questions, you can ask me. I'm not hard to reach. But look at the market. And now see, once you've started, drawing it out and so forth, and then all of a sudden you take them off, then your eyes begin to see it without even having the drawing on it. But again, the indicator is the zigzag indicator. It's on MT4, it's on Trading View. You can use that to assist you in seeing all the little impulse legs, and then eventually, you'll begin to say, it's making my chart look messy, and you're not going to want it anymore. You're going to want a nice, clean chart. And then later on, we'll get into the quarters theory, where your support and resistance will be automatically charted for you once you put them on yourself. Of course, it doesn't happen automatically, and that you'll never have to really do support and resistance again, because once you do it, it's done. It's done for good, and you'll see how the market actually plays off of those levels as well. And this little trick, something extra I have in reference to quarters theory that I use, that helps me tremendously in knowing where price is going and so forth and so on. So I hope you guys enjoyed this video on market structure, raw market movement, understanding where the market is going. If you have any questions, feel free to give me a call on Facebook, that is. All right. Hope you enjoyed it. On to the next video.